As I previously stated, I don't anticipate Tesla to see significant earnings growth over the next year, or possibly longer, unless interest rates decline significantly. Demand for the company has grown to the point where prices have increased once more, and we see those 25 to 30% margins, while also being able to ramp up Texas and Berlin at a rate of about 500,000 per year, while demand increases with this extra capacity. Supply doesn't seem all that likely to me, at least not yet, but nobody can predict the future. Things like EVs suddenly becoming even more popular, Tesla breaking through with 4680 sales, governments offering more incentives, or gas prices rising are all possible black swan events. But given the current trajectory, I don't see any of them happening. The reason this is happening is that the Cybercheck line will likely reduce earnings until the middle of the following year. If all goes according to plan, once that is ramped up, Mexico will become the next cash furnace. When Cybertech is pushed to its limit, it may produce $4 to $5 billion in gross profit annually when at volume production. Although this will be a nice addition to earnings, it won't push Tesla to the next level. We do have energy ramping, but I don't think it will be as profitable as many bulls are hoping. Instead, I think it will be closer to 20 to 25 margins, just as Zachary Kirkhorn stated on the Q1 earnings call. Nevertheless, growth exists even if it isn't visible in earnings. So we shouldn't use earnings as a measure of growth. Growth is expensive, and I don't just mean that all of the OPEX for investing has an impact on cash flow. I also mean actual earnings and profits, because this is manufacturing, and it's manufacturing on the largest scale in human history with the largest factories ever built. As a result, they will be expensive to operate and won't break even until high production rates are reached. I don't think Mexico will break even until Tesla begins producing, perhaps at a run rate of about 250,000 units annually, or even higher, keeping in mind that these will be lower-cost products too, even though margin should be decent. $25,000 is a lot less than $25,000. It's a much smaller contribution to cost, especially with a factory this size. Of course, labor and capital costs are lower in Mexico, but this growth will also be seen in the cost of goods sold in CAPEX as testers begin to build factories there, and presumably another one in India, Korea, Texas, and Indonesia, or at least those are some of the likely next sites, will require some crazy capital expenditures, which might even result in negative free cash flow in some quarters. However, since Tesla has a large reserve, this is not a problem and is what investors want to see further growth. We are excited to see that Tesla has 2 new gigafactories on the way. This indicates that the company is confident in the demand for its cars and new product expansion. The Cybertruck line is expected to open at the end of this quarter, and the cost of goods sold will be incurred. This will impact margins and earnings. Perhaps early in the following year, testing the break ground on Giga Mexico will take place. By then, Tesla should break even on the Cybertruck line, and Q4 should see noticeable profits. Until Giga Mexico opens, the Lathrop Gigafactory should be operating at nearly full capacity, which will negatively impact profits and margins. However, the Cybertruck should still be ramping up and profits should increase exponentially once it reaches a significant run rate due to economies of scale. Based on my theory, that vehicle will have some elevated profit margins. There's a chance the new Model 3 and Y are selling better due to these updates, and prices and margins would have increased, especially if costs have come down. I think in reality, it might just increase demand more to cover the additional supply of the Model Ys that will be coming from Berlin and Texas. Once further ramped, Tesla need more demand for those additional units. Hopefully they can do it partly with this refresh, partly of lowering costs and lowering prices. But I think the biggest factor is going to be interest rates finally becoming lower. And I don't think we'll see these factories significantly wrapped further until about that time anyway. It's hard to say, as these are the 4680 vehicle factories. The new Gen 3 factories are using different cells. I like to speculate it will be CAL's M3 cells, and there's a lot of evidence pointing in that direction. But we never know, it might take until about mid-2025 until Mexico starts breaking even, and hopefully if the ramp is fast, it might start contributing some decent profits by the end of the year. At that point, I believe the second-generation 3 Giga or Tera factory should open, and will begin to significantly increase cost as well. However, by then, Tesla should have grown into a fairly large company, producing between 3.5 and 4 million vehicles annually. So a new factory isn't likely to have as much of an impact on profits as it once did. We might also assume that the ramp will be faster than the Mexico factory given what they should have learned from it. Additionally, Shanghai should have the mega pack factory operating there by that point, further boosting profit. Despite their claims, these factors won't have a significant impact on profit, as profits weren't even that high last quarter, with an annualized GAAP net income of only $10 billion. Yes, part of that profit will be lost when these new factories and production lines start up. However, it won't take much for them to ramp up to have a noticeable effect. Cybertruck could reach $5 billion annually sometime in 2025 if Lathrop alone makes about $5 billion in profit annually, which would account for a 50% increase in earnings. If Shanghai Megapix factory doubles its earnings, Cybertruck's earnings could reach $5 billion annually by that time, and if Mexico breaks even by then, profits will have increased by 150% from Q1 to Q2. My point is that it will take some time for profits to increase to that point. Keep in mind that Q4 2022 had an annualized profit of about $15 billion, and that was before tax credits or subsidies. I'm happy to admit that I was surprised by the large decline in profits, which was unexpected. Even though higher costs associated with operating these factories' production facilities may have an impact on profits, it won't stop. To me, revenue growth will be a more significant indicator of this company's valuation over the next few years. Margin will vary based on interest rates and the ramping up and down of different factories, but revenue will continue to grow, and we know that eventually the tide will turn in our favor for whatever reason. Perhaps a drop in interest rates to 2%. Governments promoting climate change more strongly, all of your prices skyrocketing, or whatever, we can observe margins rising. And then the percentage returns to roughly 20 or 25 gross margins, particularly when Gen 3 kicks in, except that yearly revenue goes from around $100 billion to up to $200 or $250 billion, including the fact that energy is finally getting profitable as well. Sandy contends that until the business achieves annual sales of 15 million vehicles, Wall Street will not accept 20 million deliveries of Tesla automobiles as a given. Given that the market anticipates 6.6 million deliveries by 2030, that might be a touch early. Let's recap quickly. Following his tour of the Tesla Austin campus, Sandy Monroe shared some intriguing developments in the company's long-term plan. According to Monroe, Tesla will be able to sustain its market leadership and make huge profits because of its innovative approach to cost analysis and automobile design. Moving to 48-volt design will reduce weight and waste as well, creating a new market for the selling of switches and solar nodes, according to a 2021 Texas discussion. This is inevitable, since Tesla will not stop developing new factories and automobiles. Even if we were to produce 5 million vehicles annually at an average cost of $40,000, that would still amount to $200 billion when energy is added, along with any further testing that may be ongoing at that point. The numbers look good. 20 out of 200 billion is $40 billion, which is likely to be reached by the end of 2025 and is 4 times the profit we currently have. The market has determined that Tesla is a technology company with a lot of AI potential, so even with $1 trillion evaluation, that would be a ratio of 25. And the ratio should be much higher, because of course, anything could happen with FSD too. If that is resolved, then all these numbers are kind of moved, as the potential profit from that towers over these will be like winning the lottery.